In this brief video, I'll be demonstrating some of the methods and strategies of solving some of the tax problems, and I've selected two examples to illustrate some of these concepts. One is going to be from chapter 18, problem number 27. The other one will be back from chapter 16, and that's a discussion question number 12. And again, the objective really is to just, as I said, to demonstrate some of the strategies used in using some of these templates that I'm providing. Alright, so let's take a look then at problem number 27, and if you're interested in following along, this is in chapter 18, and it starts on page 1833. So in this example, we have two investors who are acquiring an interest then in a corporation, and they're going to form Owl Corporation. And the data is given regarding the assets that are contributed both by Tom and by Gail. And we give the basis to each transferor, as well as the fair market value and the number of shares issued, which represents their percentage interest in the corporation. So I've just, in the cells here, and I'm going to take off I like to work with magnifier, so I'm just going to take this off so you're more familiar with some of the colors that you're used to seeing. Okay, so in number 18, you'll notice, as I said, the data, I've just reproduced the data given in the problem here in the purple cells. Now, in part A, it asks for Tom's recognized loss on the sale, pardon me, on this transfer, and this transfer qualifies for 351. So Tom would not recognize any gain or loss. Part B asks for Tom's basis in Owl Corporation stock. So Tom's basis in Owl Corporation stock is going to be the sum of his cash contributed and the $240,000 basis of the installment note. So it's not the fair market value that transfers to Tom's basis, but rather in the corporation, but rather his initial basis and the assets transferred. So there's no gain or loss recognized. There's for Tom's basis is the same as the basis of the assets contributed, or 290,000, 50,000 plus 240,000. Moving down to part C, Owl Corporation's basis in the installment note. Well, Owl Corporation's basis in the installment note would be the same as Tom's basis. So in these yellow cells then, as we've talked about and have listed in some of the instructions for these spreadsheets, we'd have the answers. For part D, what is Gail's basis in Owl Corporation? Pardon me, Gail's original gain or loss first. Again, in the absence of any boot, there is no gain or loss even for Gail. And then we get to the basis of Gail's ownership in Owl Corporation, and that would be the sum of the basis of the assets contributed, her inventory at 60,000, equipment at 125,000, and patentable invention at 15,000. Then we get down to part F, Owl Corporation's basis in inventory, equipment, and patentable invention. So if we're looking at it from Owl's point of view, we're just going to bring in those assets at the basis contributed. And so if we've listed the assets that were listed using the same basis that, as I said, that was contributed. So if we scroll up here, we'll find the assets of $60,000 for inventory, $125,000 for equipment, and the patentable invention comes in at $15,000. For part G, how would your answer to the preceding questions change if Tom received common stock and Gail received preferred stock? It would not change in this case, but assuming, of course, that the preferred stock that was received does qualify. And in this case it did, so the answer would not change. For part I, Gail is considering first selling the inventory, and the objective of part I is to compare the after-tax effect of the two choices. One is her original plan, which is to contribute the property, the inventory. And remember, the inventory has a built-in loss of $10,000. Her basis is 60, and the fair market value for Gail's inventory is down to 50,000. So she's got a built-in loss she's not taking advantage of when she contributes it directly to the corporation. And that's the point of I, is to compare the financial advantage of doing one, that is to say, contributing the asset directly to the corporation, or first selling the asset, taking advantage of the tax benefit of the loss, and then contributing the net cash proceeds to the corporation, or the cash proceeds. So that's the objective of part I. So as you'll recall, the gray cells represent intermediary calculations, and those are intermediary between the data given, which is in the purple cells and just entered directly from the problem, and the yellow cells, which is the answer. And as I'll talk about briefly in the chapter 16 discussion question, that is there's a great deal of importance on getting and understanding these intermediary calculations, and so that's why I've listed them separately. All right, so if we look at the first scenario, that is to say, give it the inventory directly to the corporation with a built-in loss. First, we have to look at the realized and recognized gain or loss. Well, the realized and recognized gain or loss is going to be the difference between the projected sale price in 6 years of $700,000 and Gail's basis in Owl Corporation stock of $200,000, which gives $500,000. Then we'll look at the tax cost of that gain, which is going to be her $500,000 recognized gain times her capital gain rate of 15%. Alright, so from Gail's point of view, in present value terms, this is the tax cost. And so let's take a look at the present value a minute. And the reason we need present value, and I'll bring up the dialog box here, the reason we need to consider present value calculations is because the $700,000 sales price won't occur for 6 periods. And it would be inappropriate to consider the present value of the tax consequences as though it were happening today, when in fact it would not happen until year 6. So we need to discount then this $75,000 tax cost back to today, and we're going to discount it at 6%, which is given in the problem. So what we're saying then is that this $75,000 tax cost for Gail in the future is today worth $52,872, and again, this is if she contributes the inventory directly to the corporation with the built-in loss and doesn't sell it ahead of time. Alright, so this is the first alternative, and that's the present value of the tax cost. In the second example, she says, well, what if I sell the inventory first, take advantage of the tax benefit of this loss of $10,000, 60 minus 50, and incorporate that into my tax cost, my total tax cost. And that's precisely then what we do in this second scenario. So in the first case, we're going to calculate then her loss on the sale of inventory, which is just the, as I said, 50,000 minus 60,000, or negative 10,000. That's her loss. Now on line 48 gives us then the tax benefit that she gets if she sells the inventory early, as opposed to just contributing inventory without selling it. And so the tax benefit then that she'd get today by selling the inventory before contributing the proceeds would be the loss on the sale of inventory, $10,000, times her marginal tax rate, because this then is an ordinary loss. And because she gets to use a 28% as an ordinary loss deduction, that's a greater benefit to her. So she gets $2,800 then of tax benefit. That's money in her pocket by selling inventory. Yes, she loses $10,000, but she really lost that anyway, irrespective of whether she contributed directly or sold it first. But now she gets, by selling it first, she gets this $2,800 tax deduction. Actually, tax benefit. This is actually tax benefit. It's cash in her pocket. All right, now we're going to look then at Gale's revised basis in Owl Corporation by selling the inventory before investing in the Owl Corporation. And you can see Gale's basis is still the $50,000, is the $50,000 sale price for the inventory, cash of $125,000, and the patentable invention at $15,000. So in this case, she has a realized and recognized gain or loss of her projected sale price of $700,000 minus this $190,000 basis. Alright, so we have the realized and recognized gain or loss. Tax cost then, again, this would occur in 6 years, because when she sells the stock, she's got her revised basis. So the tax cost then for her is going to be the realized and recognized gain or loss of $510,000 times her cap gain rate of 15%, because this is a capital gain now. Well, this is all occurring in the future after she's contributed the $50,000 proceeds from the inventory and the as well as the cash and the equipment. And patentable invention, I should say. Equipment and patentable invention. She gets, in the future, she'll have a tax cost of $76,500, but that's in 6 years. So then the question is, what is the present value of that $76,500 tax cost in today's terms? And again, we use the same present value calculation, 6% discount rate, number of periods is 6, and now the future value of this tax cost of $76,500 is $53,929. Alright, so that's the tax cost in present value terms. Now if we look at the total tax cost, we're going to take the savings from selling the inventory before contributing it, and we're going to net that against her tax cost of $53,929. So her tax cost then, by first selling the inventory, taking the benefit of $2,800, netting it against the present value of the future tax cost, she will come out ahead by selling inventory first by $1,743. And then the other one I wanted to briefly look at was Chapter 16. Discussion question number 12. And I just wanted to mention in this one, this was just a set of 2 scenarios as well, like in Chapter 20, but different calculations and different objectives. But in this demonstration, I wanted to mention that how important it is again to get the intermediary calculations down, which eventually support your final answer to the problem, and then easier to retrace the sequence of calculations to determine the source of the error if there is one. Please let me know if you have any questions on these or any other problems.